So what is a statement of cash flows and why is it important in a business context? Well, a statement of cash flows is a type of financial statement, and it's one of the three most common and most important financial statements in business, along with the income statement and the balance sheet. Now, the statement of cash flows is kind of similar to the income statement, at least more similar to that than to the balance sheet, because it's showing financials for a given period of time, typically a month, a quarter, or a year, and it's looking at movement of money. It's important for financial reporting or for business owners or managers to kind of see how they're performing. It's important if you're applying for a business loan so that the lenders can see what the movement of money is going to look like. And it can be written in several different ways. I've seen many different templates, but it's really useful to make so that you can understand and anticipate if you're going to run into some cash flow issues, meaning you don't have enough cash coming in or cash available to cover your operating costs or financial obligations for your business. And it can be tricky to do a statement of cash flows properly and an income statement properly. There's quite a bit of nuance to it. You'll probably want a bit of an accounting background to understand it, because on the statement of cash flows, it's looking at the flow of money in and out, which is not necessarily revenue or expenses. You can have money coming in that's not really revenue, like maybe sales taxes. If you're collecting sales taxes from clients, it's not really revenue for you. You're gonna have to pay that back to the government. Or if you're paying like a rent deposit on a facility you're renting, that's a cash outflow, but it's not really an expense. They're just holding it for you and you're probably going to get it back. So with a statement of cash flows, it's measuring cash flows that aren't necessarily income or expenses for your business. And then with the income statement, just because you didn't have money going out doesn't necessarily mean it's not an expense, or just because you didn't actually have money coming in doesn't necessarily mean it's not revenue. So it is a little bit complicated, but I just want to give you kind of a simplified explanation of it. And for formatting, typically they're written out in horizontal form on a spreadsheet, and it'll be for 1 year with monthly breakdowns. But again, I've seen it in different ways, so there is some flexibility there. But the important thing is that it's communicating what you need to communicate as a business owner for your stakeholders or for yourself. So I'm going to give you a demonstration here of a simplified statement of cash flows so you can see what it looks like. Okay, so now just taking a look at a sample here of a statement of cash flows, which again is just a financial statement that shows a breakdown of the cash inflows and outflows of a business over a given period of time, typically a month, quarter, or a year. So in this example, I'm just using a pizzeria as a business. So you want to have that business name at the top, followed by the title of the financial statement. So in this case, statement of cash flows. And then for the time period, is that June of 2024 or for the year 2024? In this case, I'm doing Q1 of 2024 because typically statements of cash flows are going to be for multiple months. At least the ones I do are typically for a whole year with monthly breakdowns. So the first section of the statement would be the cash inflows. And here you can see I did for January, February, and March. So what are some common inflows? Would be from operations activity, generally being sales. So in this case, cash inflow for operations for the pizzeria would be, sales from selling pizza, drinks, things like that. And now there also would maybe be some cash inflow from investing activity. Maybe the pizzeria sold some of their equipment that they no longer needed. And so they might have some money coming in from that. And then also maybe there's some cash inflow from financing activity. Maybe some money came in because they were given a business loan or something like that. So basically what you want to do is look at all the cash that's coming into the business, identify where it's coming from and how to classify it, and then break it down by month. Once you've done that, you can add up total cash inflow by the month. The next section is looking now at cash outflow. So what cash is leaving the business on, in this case, a monthly basis for 3 months broken down. So again, you want to do from operations activity, from investing activity, and from financing activity. And I have seen this written in different ways, so it can vary quite a bit. But basically what you want to do here is the same thing, is track the money that's outgoing, outflowing from the business. So from operations activity, because it's a pizzeria, they have some money going out, to purchase food supplies, material supplies, to pay for rent, to pay for wages and things like that. From investing activity, they're probably not doing much for investing, but maybe here in February they purchased, a new oven or something like that, or a new refrigerator for $1,000. So that's not standard operating spending, that's them purchasing a capitalized asset, so it's treated a little bit differently. And then from financing activity. So in this example here in January, they had $10,000 coming in from financing. So maybe they received a $10,000 loan, and then starting February 1st, they're having to pay off that loan. So they're seeing $500 of outflow every month to pay back that loan. So once you've created that full itemized list and tallied up all the money going out for cash outflow, you can add that up by the month. And then lastly, you want to figure out the net cash flow, which in this case for January, they had $27,000 coming in and $10,000 going out. So $17,000 coming in. And you want to just do that for every month on your cash flow statement. And the very last thing you'll do is have a closing balance, where if to start the year they had no money, they had no cash, but they had net cash flow of $17,000 in January, now they have 17. And in February, if they had 3,500 of net, then you add that to the past closing balance and just do the same thing for March. So hopefully the video was helpful. If you got any value from it, please click like. And if you'd like to, you can check out my YouTube channel here, where I've currently got over 140 videos that cover business management and business startup topics.